Hey there, this is Ken Calcutt with Cornerstone Financial Management. Just wanted to bring you another update. It's been a few weeks since we sent one, so I thought it would be good to give you guys an update of what's going on. Today is Thursday, May 22nd, and this is a chart of the S&P 500. This is what we typically look at, and this is a classic example of why we tell people to stay invested, okay? What we saw, this was mid-February. The market was at its high point for the year. Mid-February, and then here early April. We had a big drop off in early April. So far has been the bottom of that drop. The sentiment was terrible here. Everybody was calling for recession. Things are going to get terrible, and they still could. But since then, we've had a big rally back in the stock market, 17, 18% in the S&P 500, when it really didn't make any sense for us to get a big rally. But the market has started sniffing out that maybe the tariff situation isn't going to be as bad as originally feared. Maybe we're not going to have a recession. Maybe earnings aren't going to slow down as much as they were feared to be slowing down. The jury's still out. There's still a lot of uncertainty. We don't know where this is going to go, but we've had a very nice recovery the last 6 weeks. I do not think this is going to just keep going straight up. I could be wrong. I didn't think it would have gone this far, but the market doesn't always do what we think it should. So we're at a decent point here. We'll wait and see how things play out over the next few weeks, but a nice recovery and a classic example of why we stay invested and don't panic when the news gets really ugly. I'm going to switch gears and talk about some of the things that are going on under the hood and why the market's moving the way it is. Okay, so several things going on that I wanted to point out that are influencing what we're seeing, the movement we're seeing in the market. The first thing was what I call the China pause. So 10 days ago, we found out that the agreement between China and the U.S., we're going to pause these crazy high tariffs for 90 days and try to work out a better trade deal. That's great news. Maybe some business can continue to flow with China. The market liked that a lot. We saw a nice rally all 5 days last week. The market was positive primarily because of this news. Then this week, we get some slightly negative news. This past Monday, we had Moody's is one of the 3 credit rating agencies, and they downgraded the credit rating of U.S. debt. So they went from the highest level down 1 level to the next to highest. It's a big deal, but not. The fact that we're not the highest level credit is kind of crazy, but that's what it is. So that's a little scary. But the other 2 credit rating agencies made this downgrade years ago. So this is not new news. It's just new for Moody's to do this. But anytime you get that information, it's a little bit of a shock to say, oh, wow, another agency downgraded U.S. debt. So what that's done is it's caused yields in the bond market to go higher. I know that's probably more info than a lot of people want, but yields in the bond market going higher is a little bit problematic for our financial system. We don't want those yields to go too high. It causes stocks to go down, it causes bonds to go down. So it gets difficult when yields go too high. I don't think this will be long-term problematic. I think it's a temporary hiccup for the markets because it is negative news. But we also, on a positive note, we saw an inflation report last week, I believe, that inflation was actually 2.3% for year over year. So we're getting really close to that 2% target that the Fed has. 2 months ago, we were at 2.9%. Now we're at 2.3%. So inflation is getting better and better, even though there is speculation that inflation is going to ramp back up because of tariffs. I'm not convinced that's the case. It might happen. I don't think it will, but we still have to wait and see. Another key variable that is still very much uncertain at this point are rate cuts by the Fed. So the Federal Reserve controlling interest rates here. The Fed is not going to cut interest rates until they have a compelling reason to do so. And the 2 things they're looking for, they're looking at the GDP growth, how healthy is the economy, and they're looking at the unemployment rate. That's what they're looking at. The unemployment rate, in my opinion, is probably the key number they're watching. As long as the unemployment rate stays below 4.5, we're considered at full employment. The economy's healthy, jobs are out there, people who want jobs have jobs. A low unemployment rate does not give the Fed reason to cut interest rates, okay? If unemployment starts creeping up higher, that's cause for concern for the Fed. We may be pushing towards a recession. They would start cutting rates in all likelihood to prevent recession from coming. So the good news here, that big market rally we've seen that with no rate cuts. The Fed hasn't cut rates in months. If and when these rate cuts start happening, I think that would cause the market to push even higher. I didn't put this on the list here, but also worth noting the first 90-day pause on the trade deals or the tariffs with all these other countries. You know, we're in the middle of that 90-day pause now. We expect to start hearing trade deals getting announced before that 90 days is up. As those trade deals get announced, assuming they do, that would be positive for the stock market. That would be a stimulative effect in the stock market. So there's several reasons the stock market could go higher from here. It could, but there are also a few things that cause us to pause and say, well, we don't want to get too excited, because there's a few things that could cause it to go lower. Primarily these debt issues and these bond yields getting higher, that could be problematic. So there's a whole lot of stuff going on behind the scenes that could move the market either direction. But if we step back and we say, all right, what do I think about how the health of the stock market right now? I'm generally optimistic. I feel like it's generally at a healthy spot. I don't think it's too high, too low. I think it's about right. I think the next 10% move could be higher or lower. I think we're kind of right in the middle. A 10% move either way would be a very explainable move. So we can't know with any certainty which way it's going to go in the short term, but I am generally optimistic about where things are going. I do think the worst of the fear is probably behind us from April with the tariffs. I think the worst is over, and now we're just kind of waiting on things to get clearer with what kind of trade deals are out there, the health of the economy. Do we have a recession? Do we not? So a lot of moving parts. Generally, I'm optimistic and feel like the market's about where it should be. Don't get too excited about the big rallies. Don't get too down if we have dips in the market. In the long run, it tends to work out. But hopefully this is helpful. Just wanted to share some insight into what's going on behind the scenes and how the markets are moving. If you have any questions for us or need any info, reach out anytime. Thank you.